Hi, you're welcome to this episode. In this one, we're going to be looking at setting up chart of accounts, setting up and organizing a chart of accounts. And before we proceed, we would like to emphasize the importance of debit and credit in accounting for us to be able to set the account chart of accounts up adequately. In an account, a T account splits information into left and right hand side. The left hand side is the debit side and the right hand side is the credit side. The side that is given, or for every transaction that happens in a business, a side receives, another party gives. So a side gives what another party receives and vice versa, which means the side that receives is usually recorded in the left hand side, the debit side, and the party or the entry that gives is usually recorded in the right hand side, the credit side. So, backtracking to accounting equation that was also previously explained in the very last episode. Very last episode, accounting equation was explained there. So you might check that for full explanation on that. So now, accounting equation is asset is equal to capital plus liabilities. Assets are resources or items of economic value that are owned by a business or owed to the business. Liabilities are debts of a business to third parties. To third parties, that's to outsiders, obligations of a firm to outsiders. Then equity is the owner's stake in the business. Asset means something is coming into the business that has worth. So which means asset is in the debit side normally. When asset is increasing in value, it is recorded in the debit side. Now, is equal to liability. That means everything that comes in is a result of everything that was given, which means asset that is received is equal to liability and capital, which means both liabilities and equity are the given entries. Asset is the receiving entry. So you may obtain a loan as a liability, cash will come in. You may take inventory on credit from a trade payable. Inventories will come in, the trade payables gives. Or the owner is giving to the organization something of worth. So equity will go up, the asset that is coming into the business will also go up. So asset is recorded in the debit side, equity is in the credit side normally, and liabilities is in the credit side. Now, we move to the double entry accounting part. Transactions are recorded using debits and credits. Every transaction affects at least two accounts. Equal debits and credits will keep the accounting equation in balance, which basically means for every time a transaction happens, two entries are made. An entry is given, another entry is receiving. So at least there must be one entry for each of the receiving and the giving sides, which means when something is given, it is received by another person, and vice versa. If I am giving this pen out, I am just holding it now until it's received by someone. When it's received by someone, I become the giver, that individual becomes the receiver. But as long as it's still held in my hand, it's still not a transaction, established one. So when a transaction is established, two entries would be recorded, which means the amount in the debit side would be equal to the amount in the credit side because the value of item that has been received is the same value of item that has been given. Now, double entry accounting. Asset is equal to liabilities plus equity as has been said as the accounting equation. Now, when asset which normally has a debit side, when it increases, it will be recorded in the debit side. So when new assets, new inventories, new cash, new property, plant, and equipment are obtained or purchased to the business, they will be recorded, and the debit side will be the entry because the asset will go up. On the other hand, if an asset is no more of good use, or it's old, or you want to exchange it, or you want to sell it off, that's dispose it, it will reduce the asset, right? It will be the credit side. Or you are selling off your inventories will go down, or your account receivables, that's your debtors, are paying you, which means the asset would reduce in value. And when the assets reduce in value, they are recorded in the debit side of the asset account. For liabilities, they are the given entries. So now, when you, for instance, a firm takes inventories on credit from suppliers, suppliers are given in that in that transaction. And because they are given in that transaction, the supplier's account would be credited. So when supplier is giving more and more, or the creditors are giving more, or the loan is going up, the loan account or the liabilities account will be in the credit side. But when the loan account is going down, or the supplier's value is reducing, for instance, you paid your supplier, or you to settle what you're owing the supplier's account will reduce because you are owing less, to be in the debit side. Equity also, when the owner or owners are giving more to the business, the equity account will increase because they are giving more. That entry is credit side. Giving entry is the credit side. When it is reducing, like through withdrawals, when the owner takes from the business for personal use, that's withdrawals, also called drawings, it will reduce the value of the equity, so it will be in the debit side. The normal balances, asset is debit side, liabilities is credit side, and equity is credit side, normal balance, which means everything that is received, that's asset in the debit side, is given in the credit side by either the third parties or the owner. Do you get? All assets that are owned, all items, resources owned that are received inside the business as debit side are given by outsiders or the owners. What the owner gives is credit. What the outsiders give, in quote, not for free per se, like in terms of loans or in terms of inventories that the business purchased from the suppliers, or any other item that is being indebted to the business. So it will be in the credit side of the giving side. So when these items are reducing, it will be in the reverse side. So assets, if it is reducing, it will be in the credit side. Liabilities that have an equity that have the credit side's normal balance, when they are reducing, they are recorded in the debit side, debit side respectively. So there's this acronym. We have three acronyms that we'll talk about that can help us to know which side the entry should be. So one is all crew. All crew is an acronym to show the items. Asset is debit, liabilities is credit, capital or equity is credit, revenue is credit, expenses is debit, and withdrawals debit. If you notice, assets as resources are received to the business. Expenses, they reduce the revenue or the capital, so it's debited. Withdrawals are debited also because they reduce the value of equity. Another easy technically acronym. Another easy acronym. This is easy. The first one is also easy. So it's relative. The word that is easier is relative. So it's dead click. Dead click. DEAD. D is debit all expenses, assets, and drawings. Credit all liabilities, income, and capital. DEAD. CLIC. Dead click. If you want to put provisions which is not treated yet in this topic, it will be dead clip. So P provisions are in the credit side also. But the general ones for double entry are the expenses, assets, drawings in the debit side, liabilities, income, capital in the credit side. Now, the last one, or the third one to help us as an acronym is dealer. Dealer is another acronym that helps with chart of account, the sides of accounts. D is debit side for expenses, A for assets, then L for liabilities, E for equity, and R for revenue. So you can use dealer, dealer, dealer. D is drawings in the debit side, E is expenses in the debit side, A is asset in the debit side. Then LER, that's dealer. The LER part of dealer is L is liabilities, or S is liabilities, E is equity or capital, I is revenue. Sorry, R is revenue or income. Finally, for this chart of accounts, it's a numbering system of accounts that lists the account titles and account numbers to be used by a company. Here is a sample chart of accounts for a service company. Balance sheet accounts. Assets start with 1. We've noticed that all assets, cash is 101, account receivables 102, supplies 120. We have many more assets. So that means your assets will be in 100 plus. As cash is 101, there's another asset that will be 102, another asset 103, 104, 105, 106, 110, 111, 1 to 1. As long as the business has many accounts, these assets will fall in this category. Liabilities are categorized as 200s, which means all forms of liabilities that you have, account payable, notes payable, loans, would be in the category of 200s. Then owner's equity, the chart is 300s for owner's equity. So owner's capital 301, owner's withdrawal 302, additional capital, anything that will increase or reduce owner's equity will be charted as 300 plus. Then for revenues and expenses, in one of the previous episodes that we treated the financial statements, that's financial statements and recognition of accounts. So we treated all these statements. So income statement in particular, revenues minus expenses are treated to give you net income. In balance sheet, which was also treated there, if you want more reference, you may check that video for that episode that treats financial accounts. Oh, sorry, preparation of financial statements. That's the title. For preparation of and um, recognition of financial and reporting. Sorry, preparation of and reporting of financial statements. That's the video. That's the episode that talks more about the financial statements. There are 4: statement of changes in equity, statement of cash flow, statement of financial position, which is the same thing as balance sheet, and income statement. So all revenues may be charted as 400s, all forms. So revenue ends, uh, all forms of revenues, sales revenue, all that. Then expenses will be in the range of 500s. So this is how to chart your account. At this point, I will round off this episode. And if there is any question that you have, you may put it in the comments. It will be responded to accordingly. Thank you very much and see you the next time. Bye.